Welcome to Lithium-ion Rocks, episode 23. That was BB King, an influencer of one of the most influential influencers on LinkedIn, Roger Atkins, who is a guest here alongside Keith Phillips of Piedmont Lithium, following some substantial news in terms of permitting and appointment for and timeline for PFS and DFS with their newly accelerated plan to bring 23,000 tons of hydroxide, battery quality hydroxide tons in 2023. Roger has almost 300,000 followers on LinkedIn. I'm always amazed when I look at his posts at how many hundreds of likes and reactions and otherwise. So, Roger, can you just tell us a little bit about yourself and how your background? I saw in your intro you said from electric guitars to electric cars.
Okay, yeah, well, I've been a musician in the past. I kind of still am, I suppose, but not professionally. I did it for about 10 years in my 20s. Did a few gigs here and there, supported a few bands. I was a kind of solo act. Music's been a big part of my life, and I suppose, to be blunt, part of that showing off. So the showing off bit now comes to the fore in the world that I'm lucky enough to kind of broken into, I suppose, over the last 15 years, really. Electric vehicles. So I host events talking about electric vehicles, and I try to learn as much as I can and kind of hoover it all up in my mind. I'm not an engineer, not a scientist, not a geologist. I'm actually nothing clever. Like I said, I'm just low-life, scum of the earth musician. And what I then like to do is share what I learn and try and present it in a way in which I understand it. And that seems to have found the nice wide audience on LinkedIn you mentioned. And so the background I've got is, after the musical stuff, automotive, been with a few big brands, worked at Ricardo, which is a really cool engineering consultancy. And then for 5 years, run a thing called Electric Vehicles Outlook, which is what it says. So that's kind of a quick run through.
That description sounds almost identical to me, except I'm not a musician. Rodney, why don't you fire away with your thoughts and questions? Having just been in London, unfortunately, we were trying to do this with you in person when you were presenting at Minds and Money, but we just couldn't coordinate it. But glad we have it here today.
In the shift to EVs in Europe, what is your view on plug-in hybrids versus the full electric debate? Do you think that hybrids will dominate, or will battery electric vehicles like Tesla be more popular?
It's a great question. And my sense of things is that it depends on whether you're using a plug-in hybrid to drive mostly electric. If you're using it properly, if you plug it in at every available opportunity and you minimize the number of times you have to go to a gas station, then it's a good thing. I think to date we haven't necessarily seen that. I think what's happened with, let's say, the most popular one in the UK certainly, and I think in a lot of European countries, is the Mitsubishi Outlander plug-in hybrid. Certainly in the UK for a while, a lot of people bought that simply for the tax breaks. It became a fabulous choice because it was a nice big SUV. It was pretty good. And the fact that it was an electric vehicle of sorts, a plug-in hybrid, for a lot of people didn't matter. They never plugged it in, which was not very good, really, to be frank. So I think it depends on the use case. But I think ultimately we have to go to battery electric vehicles because the hybrid, when all is said and done, is kind of only half the job. It's more complex because it's got an engine and a motor. And equally, if it isn't driven in the appropriate fashion, i.e. mainly on electric, and they typically only have, 10, 15, 20, 30 kilowatt battery packs, I'm not really sure what it's really delivering to anybody, to be frank.
The question that we keep hearing at different conferences is sustainability and carbon footprint. How important do you think the carbon footprint of the battery supply chain is going to be to EV buyers in Europe when they make that decision?
I think it's increasingly important because people are becoming increasingly aware of all the details. But let's not forget there's a twin imperative here, which is clean air in urban areas, cities, towns, etc. And anything that doesn't have a tailpipe delivers on that, end of story. You can argue the long tailpipe back to the power plant produces CO2, but it doesn't produce the emissions that are carcinogens that give people the problem with air quality. So that's one thing. And of course, it's a twin imperative, the other one being reduction of CO2. So it's a fundamentally important thing. So I think the better way in which all the way upstream, you can see a focus on minimizing and mitigating as much as possible the CO2 content of the minerals, the assembly of the vehicle, the shipping of the vehicle, etc. All of that stuff, quite rightly, and should come under real scrutiny. Otherwise, we're kidding ourselves that we're doing something that we're not. And what's the point of that? None at all. So I think it's important. It's going to get more important, to answer your question in one sentence.
Yeah, I think we agree with that. And in the overall, it seems, the rise of a sort of climate consciousness. Do you think, what is your sense about Europeans being willing to buy an EV if it costs more than an internal combustion engine? Do you think they'd pay a premium to do the right thing?
That's a great question, because when you ask it as a survey, you'll probably get, 75, 80% of people say, oh yeah, my next vehicle is going to be an EV. Oh yeah, I'm concerned about the climate. But when it comes to doing it, probably you only get a quarter of those people. So what people say they do and what they actually do is always different. That's number one. Number two, though, I think the fundamental shift really is going to be split in two ways for EVs. I do think we're going to see mass adoption of EVs quite soon. In fact, I believe it's starting to happen right now with commercial vehicle fleets, electric taxis, electric buses, electric delivery trucks. These things that are urban operating, defined mileage and back to base, certainly in any locations where you've got zero emission zones or the cost of congestion charge cost like you have, or low emission costs like you have in London. These are locations and places that now show that the cost proposition, the value proposition of running EV is compelling. So I think that we're going to see two waves. And I felt this for some time, but it's been a while coming for various things getting in the way, like the banking crisis from 2008. So I think we're now going to see a wave of accelerated wave of adoption of EVs for commercial fleets. Passenger cars is going to take a bit longer, and actually that's going to pivot around declining ownership issues as well. I think as more sharing options are delivered, more and better public transport is delivered, and more innovation in and around using vehicles, not owning vehicles, will be the bigger shift. In fact, I go as far as to say, if we just go and over the next 20 years or 30 years, shift 1 billion vehicles from internal combustion to EV, that would be a big mistake. We would have gone down the wrong road, literally. Because I think the bigger shift to come is this shift to using rather than owning, because that fits into the principle of circular economics, which is to maximize utilization. And the utilization of most cars on the planet is next to nothing. It's 5 to 10% of their time. So that's the real, if you like, carbon impact of whether it's an internal combustion engine vehicle or an EV. It's how much it's used and how many people using it, sit in it, drive in it, operate it all the time. So that's been my view for quite a while. The EV revolution comes with commercial fleets, and the ownership revolution comes with cars.
Volkswagen's strategy going for the MEB platform and doing all of their brands off that base is proving to be a smart move, as they can perfect in terms of time to assemble, and price is going to play a big role going forward.
It is, and I think they're one of these manufacturers that have now done some kind of calculation that says billions of miles traveled can be worth more than just millions of units sold. So I think they're also baking into their proposition this shift towards using rather than owning. And like I said, I think that's the bigger shift to come, rather than just the switch to EV from internal combustion. There's a great book from around about 1999, 2000 called Good to Great. It's about a bunch of companies in America that went literally from being good companies to great companies by some pretty fundamental things. And we're trying to make the world go from good to great now. So if you scale all that right up, it's trying to say, how do we do that? So you've got to have a focus on the outcome. You've got to have clear leadership. You've got to have the right people. I think the phrase they use in the book is on the bus. The right people on the bus in the right seats. And you can go for it. And that's what I think we're doing. And that's where, in terms of what I've learned spending time with Simon Moores and his crew, it is what we're not doing with the auto industry and the minerals business, where you don't seem to be, maybe I'm wrong, but I don't think I am. We don't seem to be considering that industry, given the importance of the battery now and all the mineral content within it, to really scope and plan and prepare for the future. And that surprises me, because whether it's capital market investment in mining, or whether it's OEM investment in mining, it would seem to me that if you're going to lose something, i.e. recurring revenue from friction parts, by selling EVs rather than ICE cars, you should look at finding revenue from somewhere else. And surely you go back up the supply chain to do that, back upstream. You look at harvesting margin from some of what are currently tier ones or tier twos or suppliers anyway. You kind of look for vertical integration of your business. I'm very surprised that we're not seeing that happening. And when I spoke to, I can't remember, it's Lithium Joe, isn't it? But I can't remember, what's his other name? Joe. When I hear people, OEMs say we're going to have 10%, 15%, 20% of our EVs by 2025, I kind of think, well, great, that's a nice ambition. Number one, will people want to buy them? Let's hope so. But number two, are you able to make that many vehicles? Have you actually got your guys in supply chain to write contracts with suppliers of whether it's lithium or cobalt or anything else, so that you would be in a position to deliver on that volume? And I'm not sure that's really been done. I mean, you guys might know that better than I do, but I'm beginning to wonder.
Well, Roger, this is very much a point that a lot of us are talking about in the industry, that where are the OEMs in understanding this? And part of the reason we have this podcast is to help educate OEMs who listen to this podcast, executives there. And these are big organizations. They're used to beating up their suppliers. They're not used to looking at all the way upstream. It was back in, I guess, Ford bought rubber plantations in Brazil because they were worried about tires, I guess, in the 20s and 30s. So it's been that far back where they've needed to kind of consider that. With I think Volkswagen and Tesla are the most advanced in their thinking and in their sourcing strategy. I mean, Tesla has had an offtake agreement with, I guess, Kidman, and now the Covalent in Western Australia. They have had MOUs to potentially invest in some other projects like Bacanora back in the day. BMW and Volkswagen have signed offtake agreements with Ganfeng, so they're recognizing that they need to secure the offtake. But I think what's going to, I'm predicting next year or the year after that, you will have someone like a Tesla, someone like a Volkswagen actually recognizing that maybe if they invest directly, at mine level or, through some intermediary, if they could buy lithium for $5,000 or $6,000 as opposed to buying it for $12,000 or $13,000, it actually reduces the cost, per kilowatt hour of their battery by, a couple of dollars. Tesla bought a company, Maxwell, earlier this year, a technology or battery technology company, just using all of Tesla. It was an all-share deal. There are lots of junior mining companies who I think would be more than happy to accept, Tesla paper, $500 million, $250 million, which they could, quickly turn into cash in the market without influencing the price, and use that to finance their mines. I think Tesla and Volkswagen are in the lead in this, but many others are going to have to Rodney has a famous quote now on Wired magazine that if Tesla and Volkswagen are to meet their sales goals, their well-articulated sales goals, the lithium required for those sales goals, there'd be no lithium available for any other company. So that should result potentially in panic, buying and seeking lithium supplies, which is our focus, but some other raw materials, as well. But to the extent that you're talking with those OEMs, Roger, you could be a helpful advocate in the same way that we are, in the same way that Benchmark is, in pulling them by the lapels and saying, guys, you need to focus on this, and if you need some help, call Howard and Rodney or call the Benchmark guys, and we could help advise. The best projects, the best people, and help secure the future. That because this could be a major bottleneck. It's a real concern.
I think it's a massive concern, and I really like the forensic analysis that the Benchmark guys put together, because it's all well and good saying, we spoke to a few people, we write some fancy words, here you are. People want to look at data. People want to look at, specific information. They want to look at the material evidence that describes and explains something. And I think, that's what I'm rapidly learning from spending a bit of time, like I did, over in LA at the conference and a few other things that I've been involved in. I suppose I will use the phrase, I'm shocked that I haven't seen investment, because if I look at what, for example, Volkswagen have had to spend, partly in the kind of issue around Dieselgate, but then some of the other companies too, $1 billion on something isn't extreme. $1 billion is a kind of vehicle program that, a manufacturer might put together, or, $2 or $3 billion is part of the investment in Electrify America with Volkswagen, for example. And I mean, you guys tell me, what would $1 billion buy me in the mining industry? Could I buy a couple of mines for $1 billion?
Yeah, I think, Roger, the thing is that that VW and the others, what they want is battery pack prices down to $100 per kilowatt hour. Passing that responsibility on to the cell guys and saying, here's my volume and here's my price, and basically dictating the terms. And delegating that responsibility of sourcing further up the supply chain to the battery cell manufacturer, who then passes it on to the cathode guy, who then approaches the lithium company. So I guess the way they see it is, as far as they're concerned, the cell guys are saying, don't worry, we can deliver.
But I think
when rubber meets the road.
That's making you hostage to fortune, though, and that's relying on the capability of people that may or may not be able to deliver. And I kind of just sort of think that's not a wise move. And if we reflect and consider on the fact that some big OEMs are likely to struggle or even fail over the next 3, 4, 5 years, it's going to be those that don't have this security, that don't have this ability, not only to sustain their own plans, but like I said a moment ago, to find another revenue stream, recurring revenue stream, from going back into the supply chain and owning some of it, so you can then harvest the margin. You mentioned the rubber thing, rubber plantations. Back in the day, that's what Henry Ford put together. He understood that. And I think until they saw the maturity of the auto industry and how you could make recurring revenue from the aftermarket, from friction parts, from all that sort of thing, they needed to have it like that. And we're kind of going back to that time in some ironic way. So I think there are a number of reasons why OEMs should do it. And like I said, if you're going to spend $1 billion on a vehicle program, if $1 billion buys you a nice number of mining options, either flat out purchase or, a big chunk of that mining operation, then why wouldn't you? I mean, they spend money on vaporware, some autonomous vehicle kind of dream and vision that is still going to take another 5 or 10 years or more. They're quite happy to spend an absolute ton of money on that with no material benefit in the short or medium term.
It's absolutely right, Roger. I was going to bring up that point. I mean, GM with Cruise and Honda, et cetera, with SoftBank, I mean, paying very large valuations and orders of magnitude, $2-3 billion. And if you look throughout the supply chain, like the cathode makers, the battery makers, the cell makers, they're not that profitable businesses. A cathode maker, like Umicore, is not that big a company. It's like maybe 9 billion market cap. So where the money is are with the auto OEMs. I mean, their margins are not great, but there's billions and billions of dollars of revenue. And like you say, $1 billion, $2 billion for something so critical to their supply chain is not a huge investment. And a typical mine, we look at, you ask for, maybe Rodney could help with the math here, but a typical project of, $500-600 million that could produce 20,000 tons of lithium chemicals, for 20 years, that's a good project. And you saw West Farmers essentially paying $1 billion for 20,000 tons, in a joint venture with SQM, in terms of purchase price and then follow-on investment.
You'll have to just take me through that maths again. If they need roughly, they said, which is quite astounding, but they said between Europe and Asia, they need 300 gigawatt hours by 2025. Now, that's well above their sales target, but I guess that gives you the build-out capacity for 26 and 27 when they will be selling sort of 6 million cars at, say, 50 kilowatt hours. Lithium alone would be on a 0.8 kilos per kilowatt hour. You would need 240,000 tons.
Yeah, well, this is where the numbers just start to look a bit scary to me.
I'm confident that this narrative and this education is getting out there, and the OEMs, the auto OEMs, are going to get with the program and start investing, in a more meaningful way. And the quickest way to make them, really worried about it is, when prices of lithium start spiking again because of these shortages. But it takes time from a Volkswagen starting production of their ID3, which they did just a couple of months ago, I guess, to selling mass amounts of those cars, and then that translating into battery, cathode, and most importantly, the cathode urgent demand for this high quality.
If you're an incumbent industry player, or even if you're an innovator, even if you're a disruptor, you've got to understand change is going to come in many, many aspects. So it's about planning for the future. That's the message I'd leave with anybody. Don't be complacent. Don't think it just carries on just like it is. You mentioned lithium price and supply. Even my small time in getting to know a bit about this, from famine to feast, very quickly. So if you get caught the wrong side of that, well, you're in trouble.
Well, everyone listening to that's another very smart voice talking about the boom bust, and we're now 2 years into the bust. Valuations very low. I put out a Mr. Market Scoreboard earlier this week, and so anyone listening here now, it is not hot. Lithium is not hot. Battery materials are not hot. I spoke to a bunch of people in Canada this week, and they're saying battery materials, no interest. Gold, silver, copper. That is a problem and an opportunity for the contrarians and value investors, listening to this podcast. Change going to come from Sam Cooke and growing up, Bruce Springsteen. Thank you, Roger Atkins. And now an excerpt of our interview with the boss, Keith Phillips of Piedmont Lithium, subject to a longer full episode 24 podcast. Before we begin that, I would like to remind all our listeners that Rodney and I are on the Patreon platform. Please visit patreon.com/Lithium-ion Rocks. If you like this free content, please contribute what you can from that to ensure that we continue producing it. And please look out for Rodney and me on Twitter, at Lithium-ion Bull, at Rodney Hooper 13, and on our website, libull.com. Piedmont's listed on Nasdaq and ASX, ticker symbol PLL, about a $60 million US market cap. They have no debt, no offtake partners, pretty clean capital structure, but have hit a number of milestones this year, as we'll discuss right now. Piedmont, unlike many other companies who have delayed their plans, actually brought forward their plan to produce lithium hydroxide by 2023. Today, it was announced that LG Chem and GM are putting together a $2.3 billion battery plant in the Lordstown, Michigan plant. That is, I think, a 30 gigawatt hour plant. I saw Sam Jaffe, a very astute battery analyst, mention that $2.3 billion is about half of Tesla's investment in the Gigafactory in Nevada for something of similar size. I think Tesla's is 35. So it just demonstrates how cost of battery plants and manufacturing have come down. Bloomberg New Energy Finance earlier this week came out with their numbers that showed yet again a 13% decline year on year in battery pack cost. So the trajectory of the industry is very strong. Earlier this year, Volkswagen put out what we call their Manifesto, and talked about the sustainability aspect and the hard rock to hydroxide being their preferred route and preferably close to production. Volkswagen has announced in Chattanooga, Tennessee, just a couple hundred miles from Piedmont, that's going to be the center for their MEB and ID3 production. The GM plant with LG Chem apparently was, they talked about making Cadillacs and a couple of trucks and SUVs. Keith became CEO about 2.5 years ago. Piedmont at that time, it had 500 acres, 19 drill holes, and that's about it. Is the story today, 2.5 years in, I guess, is it as good, worse, better? What are some takeaways, surprises on the upside, downside?
Been a lot of positive surprises. Our asset is bigger than we thought it would be. The grade is higher than we thought it might be, and the economics are better than we thought they might be. So the project we have within this business is that much more attractive than we thought it might be, which is terrific. It's, as you said, a 25-year project, 22,700 tons a year of lithium hydroxide at around $3,100 cash cost net of byproducts. That would be the lowest cost producer in the world. We're confident that directionally those numbers will hold up in the PFS and DFS. It's just that we're very fortunate to be in an amazing environment in North Carolina. The one negative surprise, it's been interesting to see the strong growth in EV kind of adoption by the major OEMs and development, and you look out 2, 4, 6, 8 years, it's really, really exciting. It's been surprising to see the short-term downdraft based on the oversupply issues we faced really coming out of Australia in the last year or so, which are clearly having a big impact, but I think will be temporary. So I think I share a view of most people in the industry where I'm surprised prices are where they are today. I expect them to be far stronger in the medium term. Surprised where stock prices are for a lot of companies today. I expect those also to be far stronger in the medium term. But long story short, after 30 months in the job, very happy where I am, very excited about our unique project, and really bullish about the long-term fundamentals for the space.
It's the end of the year, so kind of taking stock of what happened this year and looking forward to next year. Neo Metals, this time last year, sold their 14% stake to their partners, Ganfeng and Mineral Resources. They paid 104 million Aussie. If you do the math, it was about 515 million US just for a spodumene minority stake, although it did give them joint control of that asset. From Ganfeng's perspective, that is very much a vertically integrated spodumene to both carbonate and hydroxide, relatively rich valuation. Then you had this time last year, Albemarle, obviously with their $1.2 billion, which they increased to $1.3 billion, although they restructured that joint venture a bit. But they had every opportunity to walk away from that deal in the middle of this year, but did not. Likewise, West Farmers with Kidman paid essentially $525 million just for that asset, and they've increased the capex, I think, to $700 million Australian dollars just for their take. So that's like $1.1 billion US investment in Kidman for a project for their half share is only about 23,000 tons. I say only, but that's the equivalent size of the Piedmont Lithium project. So you're sitting here at a 60 million US market cap, and you have these three data points of real strategics understanding the hard rock to hydroxide vertically integrated strategy. That to me demonstrates, the value of these assets.
I think what's clear is smart money understands the long-term strategic opportunity. We're at, give or take, 2% EV penetration right now. That number is going to rise very dramatically. I think, frankly, some of the longer-term estimates will prove to be conservative. And I think people understand this is a very exciting opportunity, and there happens to be a real valuation opportunity for investors now with the relatively short-term sort of dislocations. We have the only American spodumene project, so it's interesting. The three transactions you spoke about were spodumene-based. So having a spodumene-based integrated business on private land in North Carolina is very interesting. It's the only, again, American spodumene project. It's the only American greenfield hydroxide project. And it's in the eastern U.S. on private land with a federal permit for our mining operation. So we feel exceptionally good about our strategic position, and I think we're confident to the extent we're interested in partnering or having strategic conversations that others will see our assets similarly, and some of those conversations are ongoing. Financing a project like this, I think the economics are very strong. It's in the ideal location. There's literally not a better location to be doing what we want to do. So I think the financing will take care of itself. I really don't worry about that.
Talk a little bit about sustainability. Even though the carbon footprint of any lithium project is relatively small to, say, a nickel project or a copper project, but it seems to be held to like a higher standard.
The issue of sustainability is critical. It's very important. That was made clear to me in conversations with one of the biggest OEMs in the world when it was front and center of their discussion. Issues, transportation distances, what sources of energy will you use, et cetera. And the good news is it's really good for our project. So right now, a typical lithium molecule, as Sam Jaffe would say, would travel from South America, say, into North Carolina to be put into be upgraded to hydroxide, then shipped to Japan or Korea to go into cathode material and a battery, and then shipped perhaps to Nevada to go into the battery plant, the gigafactory of Tesla, and then into California. So it's sort of a 25,000-mile trip. Imagine a scenario where we produce lithium hydroxide in North Carolina and on our site and ship it, an hour away or less to a cathode plant, which then goes an hour further into a battery plant, and then maybe an hour to some car plant. And that's very important for the car company and for the big battery companies, the LGs of the world, who are these are major corporations who are very concerned about these things. And it's very good for us. I mean, it's great that it's sustainable environmentally, but it's also less expensive and lower cost, and that's important. So it's commercially very sustainable. Big advantage for us that our chemical plant's about 12 miles away.
So you've defined a 25-year mine life, which is basically just a subject of like you're having acquired land and drilled out certain portions of it. But the USGS, I think, estimated there's some 750 million tons across the whole belt. We had Luke Kassam on the podcast earlier this year saying that Kings Mountain is greater than 20,000 tons for 20 years.
Carolina tin spodumene belt is huge. There was an article in an Australian technical magazine earlier this year that identified it as one of the three big belts in the world, alongside Greenbushes and Monono in the DRC. So it's a massive belt, 750 million tons. Maybe 50 million tons was mined previously. So there's clearly a lot more there. We're the biggest landholder now. We have 27.9 million tons of resources. Virtually every drill hole we've executed has hit high-grade mineralization. There's an awful lot of the belt we certainly don't control and haven't drilled. And so I think the opportunity is quite vast. Making it a lot bigger, we think, is something that's viable. But an opportunity that I think exists is to really, you think about all the spodumene in the world, from Australia, from places like Canada, Brazil, parts of Europe, parts of Africa, Right now, the only place to sell that material is into China. There's a handful or so of high-quality converters in China. Everyone in the downstream business, in the battery business, and in the car business is looking for sources of supply outside of China. They understand that China will be a large component of the business forever. That's great. But people like diverse sources of supply. So, the opportunity to grow our business by converting other people's spodumene in North Carolina is something that we think is actually interesting. It's something we'll be studying next year.
Partnerships are very prominent in this industry, and there's a sentiment in the industry that a junior can't, develop a project on its own, right? It has to have, some sort of partner. And if you have to have some sort of partner, then the partner has a lot of, cards to play in terms of, valuation.
We're totally focused on shareholder value and kind of risk reward. So if we have the opportunity to work with a very strong partner like Kidman did in bringing in SQM, like Minres chose to do with Albemarle, of course we'd be open-minded to that. And they have great expertise. They have access to capital. They have customer bases, et cetera. But I don't think we need it. And I will say there are other companies that aren't currently in the lithium business who have expressed real interest in the lithium business. It's very, very rare to find a business that's relatively green. It's a green mining operation, essentially, where demand is growing, expected to grow 20, 30% a year for a couple decades. It's very unique. That doesn't happen in copper or in coal or in a lot of businesses. So people are looking to get into it. There are a lot of people in the chemical industry who look at lithium and understand its complexity, but they don't view it as rocket science. So I think there's an understanding perpetuated by the majors for their own selfish interest. I think that gee, this is really, really, really hard to do. The only people that can do it are the 4 or 5 of us that are doing it now. I don't think that's true. And I think when you look back in 10 years, there'll be a number of people who've demonstrated the capability to produce these materials. And some of them will be new entrants. When you see Wesfarmers coming into Kidman, they're a big company. They have a lot of expertise. I'm sure they'll learn a lot about lithium and then they'll develop more expertise. I think wouldn't rule out others of that ilk that no one's ever heard of before in a lithium context coming into the business and playing an important role. North Carolina is the cradle of the lithium business. It all started there. There's probably more English-speaking lithium processing talent within 15 miles of our site than anywhere else in the world. So, building a team is something we'll be focused on in the first half of next year, and that's an important opportunity. The other thing I would say is, it's a business where the people who need the batteries are the car companies. Those are big companies. They're 20, 50, $100 billion companies who really are highly motivated to make sure their suppliers of batteries, LG, SK Innovation, Panasonic, et cetera, can deliver the right quality batteries. Then you go down to the cathode producers, the lithium producers. There's an immense amount of expertise in the supply chain. Those folks are highly motivated to help people like us develop a product that works for their supply chain. And those are conversations we're having now. As a general matter, if you assume a producing company, a steady state producer, would trade at, say, 1 times NAV. When a project's de-risked, people pay more for it. We've had some really important de-risking events. The first was really making the business big enough for people to care. So we believe we've done that with 25-year mine life, 22,000 tons a year of lithium hydroxide, ultra low cost. The federal 404 permit for the mine and concentrate plant, huge de-risking event, and then working toward bankable feasibility study by the end of the year with all the permits in place. The business is just worth more. It's closer to cash flow. People can have a higher degree of confidence in it. But as a general matter, the market's going to rebound strongly. I'm confident. I personally have no personal doubt about that. I think when that happens, the big guys are going to be looking for consolidation opportunities, ways to position themselves strategically. One thing they'll look at is for assets in unique places, conventional, high-quality assets in interesting places. We have the only asset of that kind in the United States. It will have very high strategic value for somebody someday. And our job is to position this company as being attractive to the most broad group of possible investors, including those in the public market in Australia, in the U.S., and elsewhere, and in the strategic world with private equity folks and offtake partners and potential strategic partners, et cetera. Imagine a world where in, say, 2024 or 25, we're producing 22,700 tons of hydroxide, and prices are at the levels Roskill's projected, which is the deck that we've used and a lot of others have used in our in our models, and we're generating $300 million US dollars of EBITDA, and we have a 20-plus year life. It's a highly strategic asset. And there's an opportunity to grow that by getting more land, drilling more, maybe converting some other people's material. You could grow those numbers dramatically. You could imagine and you can envision, and I do, a very, very significant value in a business like that. That's a multi-billion-dollar public entity.
This time last year, there was a lot of tax loss selling in the market. I don't know if we'll experience that again this year because a lot of people kind of took their losses last year. But, from around this time last year to May, Piedmont stock, nearly doubled. Things can happen, very quickly, in this market. Any final comments or thoughts before we sign off?
Well, first of all, Howard, thanks for doing this with me. I was pleased to do it. I think the work you and Rodney are doing is fantastic and really helpful for the sector. And again, it's a nascent sector. There aren't a lot of people with real depth of knowledge like you guys have. It's great that you can bring it out to people. I would wish you and everyone listening happy holiday season and a very prosperous 2020 for lithium investors.
Lithium-ion Rocks, Lithium-ion Bull, and through our respective LinkedIn and Twitter posts, Rodney and I may share with our audience some rationale for a stock for which we have conviction, to own or not to own. If you agree or disagree with and act on or against the rationale of anything said or written in this or any other lithium-ion rocks or lithium-ion bull, that's your free choice. But to be clear, what you are listening to or reading is not investment advice and may not be unbiased. It should not be construed as an investment recommendation to buy or sell any security. Rodney and I are not registered investment advisors nor broker-dealers. Please visit libull.com for further disclaimers.